Hey guys, it's Jay from Investonomics, and it's that time of the week again. It's lecture time. So this week we're going to be talking about monopolies, and we're going to be hopping back to our economics section of the channel, and we're going to be talking about monopolies, give you some examples and how to analyze them. So I hope you enjoy this one. I'll see you next week. Hey guys, welcome back. And today we're going to be talking about monopolies. A monopoly, in general terms, is a company or an entire industry which has exclusive access to a certain population or region, such that there's no competition from other firms or other industries in that region. Monopolies are prominent in industries where production relies on two separate things. The first is control over scarce resources, and this can be things like gold, copper, and oil, and we'll discuss this further. And the second is economies of scale. If you've never heard of this before in your classes or in general, it simply means that as the monopoly or the other firm produces more, their cost of producing each additional unit becomes less. So it becomes cheaper to produce in essence. So in terms of the scarce resources, this can include natural resources, their reputation, a specific technology or government patent, and network effects. And this can be seen through Facebook, where you have to connect with your friends, and Amazon with their network distribution. The initial cost to start is very high when we're talking about economies of scale, but as they increase production, the average cost to produce is very low, so it falls. And electricity companies experience this. As they produce more electricity, it becomes cheaper and cheaper. So we'll look at some key features now of a monopolist. So one of the most important key features of a monopolist is that it has market power. And by this, I mean that the demand slopes downward, which indicates that there's a negative trade-off, like we've seen before, between the price and quantity. And this isn't true for perfectly competitive firms. So here I've drawn it out here, so we have price and quantity. This is a perfectly competitive firm, and we can see that the market price indicates that the firm chooses quantity, but they can't choose the price. And I'll do a future video on this. Meanwhile, for the monopoly, we have a downward sloping demand curve, and this is more similar to the demand and supply lecture we saw, and that price influences quantity and vice versa, and this means it's for a unique product or service where they can charge different prices. And the second key feature is that no competitors exist that affect the demand of the monopolist. So in general, in economics, we calculate revenue as follows. So we have the price or demand curve times quantity, and the marginal revenue, or MR, is simply the rate of change, or the first derivative, if you like calculus, of the total revenue. But this is just a fancy term us economists use. And this is used interchangeably with revenue. So the marginal revenue is the rate of change of a total revenue for each additional unit that's produced. And that's the key. The marginal cost is derived very similarly in that it is also the total cost, and the marginal cost is the first derivative. So essentially the marginal cost is the rate of change of total cost for each additional unit produced, so it's the additional cost that the firm incurs. A monopolist strategizes to maximize profits exactly where the marginal revenue is equal to the marginal cost. Essentially, this means that the additional cost of producing one more unit of good at this point exactly equals exactly the additional revenue from that unit, so they perfectly offset. So to better understand this, let's build an intuitive example and a visual illustration as well. So let's look at how to derive the marginal revenue. So we'll take a generic demand equation here, and this is the equation of the downward sloping monopoly's demand curve, which is what we're going to be looking at. So here we can see we have that general equation, y equals mx plus b, typical format, and we have a as the intercept and b as the slope. And then we create total revenue. You just multiply by q. If you've taken an economics course, just multiply by q, and you get this equation here, and you can see here that we have those extra q's in there. And then the marginal revenue is found by taking the first derivative of this with respect to quantity. So here we end up with a marginal revenue equation. And something really interesting is visible here. So intuitively, and for visualization in a moment, it's clear that we have a curve identical to the demand curve, but it's twice as steep. So it's important to note here that because the monopolist charges a single price to all of its customers, the marginal revenue has to lie below the demand curve, and this is just a rule you should remember. The marginal cost is found very similarly, so now we'll take a look at the profit maximization and a visual example. The profit from monopolies, as we can remember from before, is determined where it's maximized, and this is where the marginal revenue is equal to the marginal cost. So here I'll start to draw it out here. Quantity and price on the axes here, and we have the demand curve and the marginal revenue. Here you can see twice as steep. And I've just taken a general example here and taken some random numbers. So we have 100 minus 2q. I've derived the total revenue, multiply by q, and then take the derivative, and we see that the slope is twice as steep. And I've just taken an arbitrary marginal cost equation. And we always have a fixed marginal cost for monopolies. Now you can see that marginal cost at 20. I've drawn that 100 intercept and the half point because the slope is twice as steep. And there's the perfect competition equilibrium that shows what the profit level would be. And now we want to find the equilibrium price of quantity using that marginal revenue equals marginal cost. So here I've set that up. You can see that marginal revenue equals marginal cost. And we solve for QM first, which is just the Q. And we can see that equals 20. And then you can draw this on the graph right where those intersect, the marginal revenue and marginal cost. So now we can also plug this into the demand equation to find the price. And that will give you 60. So there, now we've found the equilibrium price and quantity. So as long as a monopolist operates above its total average cost per curve, it's profitable. We'll talk about this curve in a different video. And this is the deadweight loss that is formed as an inefficiency due to the monopoly being in action. And you can see a higher price and a lower quantity. So again, touching on this, monopolies restrict the quantity and charge a higher price in order to increase their profits. And this is over perfect competition as the baseline. So in general, price of monopoly is higher than perfect competition and the quantity is lower. And the deadweight loss represents the market inefficiency in that the quantity is too low for a monopoly. There's been many debates for and against monopolistic behavior in the marketplace, and antitrust law serves to break apart such large companies and ones that hold too much power and price gauge. So Standard Oil is a common example. You might have heard of this in your history textbooks, and it was owned by John D. Rockefeller and was one of those cases, and the child companies that actually sprung from this include ExxonMobil and Chevron. And an ongoing one that is Apple and its App Store service charging, which you might have read about in the news. So currently what's going on is Apple's undergoing proceedings, and this is filed by Epic Games, and it's given that Apple's monopoly is over the online game market and that it pockets over 30% of all the profits made by developers. And this is because it can only be accessed through iPhone and iPad. There's no other way. So currently Antitrust does not have a foothold given the online nature, but the case is ongoing and we'll see where it goes. So we'll see you guys next time.